Nice move down on SoFi today. I like it. Buying it on the cheap, cheap, cheap. Raytheon's down. Because it does look like the market's probably going to try to take another leg lower. Semis are the last shoe to drop as usual. Amazon, Google still strong. Netflix holding steady. Software is getting wrecked today. That's the common theme. What else we got going on here? What's the IWM doing today? IWM is up zero point 0.7, down 0.76, lagging immensely. Gold, silver under pressure. Yields are strong. VIX is green. Yeah, I wouldn't be surprised to see these SOXX start to roll over at some point. Big bounce holding that 7-day moving average. Interesting spot. S&P potentially setting up a head and shoulders formation. Obviously, it's FOMC day, but yeah, we got to see. I don't expect too much more movement for the rest of the day. We're probably going to do a lot of chop and slop. At least in the indices, I'm not expecting a big movement. Oh, I got to change all this other shit. Who else is reporting earnings? Ton of earnings. Microsoft, Meta, Google, Qualcomm, big boys on deck. Chipotle, Ford, Carvana. I wonder how juiced the Carvana puts are. I feel like Carvana's probably going to get smacked down. I haven't looked at that chart in a while. I got to take a peek at it. Sorry, I'm just still setting everything up here, guys. I don't think I'm going to take any trades up until FOMC. I'm going to look at some of the chain and probably put on maybe a spread, a risky spread trade. Good morning, Y, or good afternoon, YS. Yeah, a ton of earnings still after hours. KLAC, Vici. eBay after hours. Look at Starbucks go. Starbucks up 10%. This is a beautiful pattern, guys. Starbucks is heading to the moon. Do 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 do. Next stop for Starbucks. Upsloping wedge pattern, but ultimately it's probably going to take out 120. Nice. My average on Starbucks shares is 91.48. Been sitting on that position for a while. So it's good to see that it's finally starting to perk up here. I like it. Let's look at Hood. Yeah, Hood is just getting decimated, guys. SoFi as well. This is a nice gift. I'm so happy that we sold everything in SoFi because this one actually might try to take out the lows still. It's very tempting to buy equity down here, especially ahead of that S&P rebalancing. But honestly, I mean, right now it looks like SoFi is gonna maybe try to test even, I don't know, 13 bucks would be wild. I'd back up the truck there for sure. That's a big drop. What else we got shaking and moving today? And Intel's just ridiculous. That's wild. YS is saying you did Micron puts today. Let's take a peek. MU. Yeah, that one's still up on the session, strong with semis, but coming in. Oof, look at Poet. Poet is down another bit. Another 13% on Poet. That is filthy. Ondas. Holy shit, I was looking at buying Ondas yesterday. I'm glad I didn't. Today it's 9% cheaper. BBAI, that did a reversal, I'm pretty sure. Yep, it was green in the morning. Now it's down sharply. What else we got going on? AMD still green. Tesla's under pressure. Palantir's down. Joby's down. Yeah, these eVTOL stocks looked good yesterday too. I thought they were going to break out. Now they're under some pressure. Interesting. Hmm. Still might be an opportunity in them. Good to see quantum stocks are finally coming in a little bit more, getting a touch of a bounce. I'm going to tell you guys, don't sleep on this IMPP. This one's going to have a huge parabolic move at some point. This is a beautiful chart pattern. I mean, we're at the precipice of triggering. Look at this move. This is going to be stunning. Right into that 6 handle. I like it. Come on. If IMPP can do the squeeze that I know it's capable of, it should do a huge. This is a massive base for IMPP. Setting up almost a cup and handle formation. If you break out of this stage 1 base, this is a 4-year base, well, 3.5-year base that is built here. Holy shit. This one could be a flyer, guys. We could be looking at 11. Pretty cheap to buy equity on it, too. It's risky. There's still a lot of people in denial about oil, but oil is just going ridiculously crazy. Let's look at SMG today. Big dip on earnings. It was green. Still think that's a strong swing. Let's look at ADM. Yeah, that's breaking out as well. Let's look at wheat. Wow, look at wheat, guys. This is super inflationary. If we look at the DBC basket, guys, commodity basket, oh my goodness. You know what? On second thought, I think Powell's going to have to come out hawkish. Holy shit, look at that breakout on DBC. That is filthy. Wow. This is a commodity basket that has this is massive. Look at this chart, guys. Is anybody seeing this? I mean, holy moly. If this is like going to the moon, we're all screwed. That's one of the biggest inverted head and shoulders, guys, I've ever seen on the weekly time frame. It's more so a monthly. Oh my goodness gracious me. If we break out of that, that's going to be wild. Let's just draw this pattern up here. That is one of the biggest inverted head and shoulders, guys. Oh, I wonder if this basket has uranium. What is URA doing today? Uranium is negative. I need to see. Let me just Google something real quick. DBC Holdings ETF. Why the hell are you asking all these questions? All right, portfolio, DBC. So 19.3% crude, and that's part and parcel because oil has been so strong, it's skewed the averages. Gold, gas oil, cattle, corn, soybean. Oh, I think they adjusted it. I thought it had wheat in here last time I checked. Cool. I guess there's no uranium in that. Interesting. Yeah, that's a crazy move though. What else we got going on? Nokia is still holding strong here. Oh my God, man. Some of these charts, guys, are ridiculous. STX as well. Western Digital just keeps on ripping. I mean, these charts are crazy. Absolutely crazy. Our markets are one big frothy casino. Rocket Labs. How's Rocket Labs doing these days? Nice little back test. Ooh, I might try to start a position on RKLB. That's a good little. RKLB hitting the 20-day, guys. That's a pretty good back test. Hmm. Wait, how's copper doing today? Copper is still flagging. Trying to build a little bit of a base. Yeah, so I think they're gonna keep us pinned, guys. There's probably better trade setups in individual names versus as opposed to the indices. What's the VIX doing today? Hmm. Interesting. VIX is barely red. Oh, what was that spike down? Did oil just do another spike? Yep. Yeah, oil's just monster, man. Holy moly. Absolute beast. All right, I'll be right back, guys. Just when I said the indices are not going to be volatile. Holy moly, what is happening on the indices? Where's that sell side pressure coming from? Is there news? I gotta get my headphones. I feel so out of touch with the market when I miss the morning session. Where are my headphones? Shit. Holy, what a candle dump, guys. Oh, man. They send it to the basement, baby. Go, go, go. Look at that. US CENTCOM has prepared for a short wave of strikes. Boom. Thank you, YS, for posting that. The war is not over, man. The war ain't over, guys. Crude oil ripping to the top side, baby. Let's go. What a dump there. We just need semis to roll over. Fucking Intel, man. Damn Trump. Knew it was a tough short. Just give me 1 sec. What a candle down. Today's the last day of 60-day limit. Interesting. Good to know. What a nasty dump there, guys. I gotta go to the SPX larger time frame chart just to see what we're working here with here for moving averages. 4-hour chart. Okay, so we're coming into a 4-hour chart support level. I do think they're gonna likely save the market here at some point, because I think that they're gonna blame the market sell-off on FOMC if we do get one. I don't see how the market's gonna push here on FOMC. Powell must be walking into this meeting saying, holy shit, crude oil up 6.5%, crossing $100 a barrel again. I'm gonna have to be a fucking hawk. Look at how elevated we are on the daily chart of SPX still. We're still super frothy. Man, I want these semis to just fucking go down. This is where the sell-off could be so deep today. If semiconductors give it up, the sell-off could be deep. I'm getting hungry too. I need to go eat some lunch here, guys, but lots of action. Man, crude oil's just going parabolic again. Now up over 7%, guys. Holy moly. Great job, YS. You're pretty fast at giving the news here. You should be a professional squawker. I like it. You actually beat some of the squawkers I listen to. They just literally commented on it now, your same headline. So nice job there. Appreciate that headline. Man, Intel cooked me. Anybody buying anything before FOMC? Taking any trades? SPY's looking heavy here. I mean, shit, look at this head and shoulders, guys. If this triggers, the downside potential is pretty big for your S&P. But I imagine they're only gonna, if we break, I imagine it's only gonna be on the FOMC headlines. But damn, it's looking nasty right now. That takes us right down to like that 701 target. Interesting. 8.6% potential drop. If that played out in one day, that would be wild. Because it's looking like does look like this market's going to roll over here, showing incredible amount of weakness. The sell side pressure is coming from semis. Yeah, feeling good this morning, but contracts are probably fairly juiced across the board. I haven't really looked too much. Obviously, there's a big volatility event, and then you have the mags reporting, right? So I think it's like 30, almost 40% of the S&P reports. It's like 37% in one day. You just sold your MU puts. Nice. SOX just looks like it's starting to roll here. A little bit of hourly chart support, but I don't think that hourly support. I think they're going to flush SOX at minimum back down to this gap fill. This was where price action yesterday, gapped over it, this previous gap. Price action wicked through it, got rejected pretty hard, back down to that other gap. They bounced it yesterday, rejection again at that gap. Then this morning they gap it up over the gap. So I mean, these semis are just all over the place. But it's just crazy with Intel. Intel's just absolutely a monster. Was there a partner? I haven't even looked at the Intel news. There must be news on that pump. But that's the main reason why this semiconductor ETF is strong. Uh, oh, it was Intel earnings. Fuck, how did I miss that? I totally forgot. No, that was a few days ago. What was the news? Intel soars after CEO says CPUs are now the backbone of AI. Like, come on, really? What a fake pump, man. That's like crazy. That's not even that crazy news. But I appreciate you letting me know. That's ridiculous. That is pretty ridiculous, that Intel pop. Nvidia obviously showing some weakness today. Lots of head and shoulders on all the semiconductor charts, man. If we can just get them to trigger, these markets are going to get cooked. Software's still getting annihilated. Yeah, my Intel puts are wrecked. I mean, I was not expect. I thought I was waiting. I'm like, you know what? I waited a few days after earnings. Probably all the news is priced in. It's had a parabolic run, and then bang, fucking news, man. Just to wipe out the shorts. Like that news headline, I don't think justifies that pop, but that's just the way it is. That's just the way it is. What time is it? 12:38. I'm gonna be back in like 30 minutes, guys. Maybe less, probably less. 15 minutes. I just gotta go pick up my tire. Luckily, the mechanic is just down the road from me. Just got a call. But I'll be back in like 15 minutes or so. But the market looks weak. Crude oil is still super duper strong. I mean, by the end of the day, Qs are going to be red. Amazon's probably going to be red. All mags are red except for Amazon. So everything's starting to see definitely some decimation of price. Fucking Intel, man. I hate Intel right now. All right, I'll be right back, guys. All right, I am back here, guys. We are back. Ready for FOMC. What time is it? 12:47. Still got just over an hour. Dollar's still strong. Thanks, Wes. So again, we're probably going to get two specific movements. You're going to get that initial spike at 2 o'clock where they announce interest rates. Policy is to hold rates. Let's just actually look at the Fed curve and kind of read into the macro a little bit. Fed watch tool. It's always a good thing to note. Yeah, look at that, 100% rate cut. Crazy. So it's 100% rate cut or 100% hold right now of the current rate. If we go to the June, April, May, June. So remember, there is a 2-month delay. So April, the next cut is in June, or the next rate announcement is June. I shouldn't say cut, but also 98.6% probability of a hold in the June period. Okay, let's look at July. Also, super duper strong. And this is one of the main reasons why I'm shocked the market has actually held up, just on a macro level. Cost of capital, the rate curve has changed drastically. I mean, we go to September now, and look, we're still a hold, 94.4% of a hold. October, still 92% chance of a hold of policy. Wild. That's wild. The cuts just keep getting priced farther and farther out of the curve. Then we go to December, end of the year, still 90%. Now, this is where I think we could potentially have a little bit of a incorrect pricing of the bond curve. Because we go to December, the end of the year, and the market's not expecting any more cuts. However, and the real reason the market's not expecting cuts is because of oil. That's it. That's the only reason why. Inflation pressures. But if we get a squeeze on oil, let's just say, let's go to this US oil chart. And you can see it's having a nice technical breakout today. Weekly chart. Even the monthly candle, guys, we're looking like it's going to take a lot of downside pressure to push US oil back below this pivot high. And then the crazy thing about this price action, not only are you getting a monthly higher high confirmed breakout here on oil, but you're also potentially setting up another higher monthly close compared to last month. So that drastically swings policy. The next real resistance to clear is going to be this area over here, which is about 115. That's the next big area. But if we get, and the symmetrical move, if this ABC wave plays out similarly to how it did here, the end of this C cycle, the last wave here, should take oil to 151, 150 by September. So if we do get crude oil to complete that C wave and fulfill the symmetrical move, which it's looking more and more likely that it could happen, that is probably actually going to cause the economy to collapse. I don't think there's a way around it. You know, I've looked back at every cycle, and oil above 100 doesn't mean good things. Does not mean good things. Now, it may take a while. I mean, if we look at the previous cycles here, 2008, obviously it took oil basically from January 2007 to June of 2008. So how many months is that? Let's just get out the tool. Was that 16 months or something? So that was 578 days, basically almost 2 years. Let's call it 1.5 years for simplicity. The interesting thing though is price action is squeezed so fast here on oil that it seems like this cycle is playing out quicker. So if you do a symmetrical move similarly to this C wave here, this B to C, this should play out latest by September. But like I said, if we get a move into the 140s, it's going to crash the economy. And you're probably going to see a big deflationary wave like this. This ended up marking pretty much a collapse in the stock market. You know, if we look back, so oil peaked out here on, what was that candle? July of 2008. Let's look at the SPX chart here. Remember, the market topped out before crude oil, had this bounce, and then you can see as people were pricing in a reversion trade in oil, you got a little bit of a multi-month bounce in the S&P, but then came the big selling. And look at that. The July candle is here. So this July candle is a little bit of a wick here. That's when oil topped out. And the market still imploded. I got too much friggin' happening here on the charts. I gotta erase some stuff here. Gotta make a note as well. And so this is why I think that the bond market potentially has the curve priced incorrectly, and it will change quickly. Oil 2008 top. So if we get that deflationary event in the economy, which is what crude oil will likely do, the whole interest rate curve will change. We'll likely get cuts start to price in. But at that point, you know, that's where unemployment's going to start to uptick, and that's what crude oil is notoriously good at doing, is when it keeps charging higher, it's going to put downside pressure on the employment market, the labor market. You're going to see deterioration in the labor market probably over the coming next 6 months. We're already seeing it. We're seeing layoffs everywhere. Mags are announcing layoffs, then they're going to blame it on AI, but it's really going to be oil. Squeezing profit margins, raising prices everywhere. So it's interesting. This is probably going to change drastically. But then we go to January 2027 and we're still at a hold. March, still at a majority hold. April, still majority hold. But then you look at this, we're heading into 2027. Instead of more cuts, they're pricing in raising rates. Wild. How wild is that? June. So the bond market's probably going to get flipped on its head. If the bond market gets flipped on its head, the stock market's going to follow suit. Still, we're all the way into June here in September. Look at that USO chart. Look at that USO, guys. USO also looking so strong. Wild stuff, man. Absolutely wild. That's a stunning inverse head and shoulders is just playing out so fast. Super incredible. And this inverted head and shoulders pattern, guys, gives USO an upside to 170. But like I said, by that price, it's not going to take long for the economy to start faltering, in my opinion. I hate to be a bear, but that's just the reality. You study the oil spikes and sustained oil prices, it doesn't usually mean good things for the economy. And honestly, guys, when oil tops out, it actually falls at a faster than the stock market at a 2-to-1 ratio. So that's what the cool thing is going to be. We're going to get such a fat opportunity to short oil. I mean, when you see how oil starts to decline, if we start to go into recession, I mean, these declines, guys, are life-changing gains. You know, 1, 2, 3, 4, 5, 6, 7, 8. If we buy an 8-month contract or even a 6-month contract or a 12-month contract, you know, far out of the money, you can get paid. But oil falls faster than the stock market at a 2-to-1 ratio because there's a lot of leverage. That was an 80% correction there, just in 08. Let's look at this US oil chart. This is a mind-blowing correction. 77.5%. Well, fingers crossed tomorrow. Another rental property secured. House deal should be closing tomorrow. And then you know what else trade, guys? Once oil does top, natural gas, man. This is going to be a big trade as well. I can't wait to go long because once we get the capitulation flush on nat gas, there's going to be a big trade here. There should be. Because what's happening right now, there's still a lot of people in denial and disbelief about oil. But right now, there's a lot of people that are trying to transition away from oil, and it's more so not residential. It's going to be the industrials that want to trade natural gas more because it's way cheaper right now. I mean, you look at where nat gas was trading basically at the start of the year to now. Way cheaper. Way, way cheaper. Nice decline in hood. Was anyone buying hood down here? It's getting better. Hood's getting more attractive for sure down here. You might just pin us here. It's probably a good time to grab lunch, take a break, do whatever you got to do. I'm gonna rest my voice until Fed. I'm just looking through the chain here. Hmm. If the market gets any sort of a pop today off of FOMC, probably a good short entry. Um, I'm honestly thinking of taking puts into FOMC. I might wait until after the 2 p.m. 2 p.m. you get the rate decision, which is a hold. And then you'll get a little bit of volatility. Usually markets stay range bound. So guys, I'm just looking through the chain right now. Puts are more expensive right now on the SPY 0 DTE chain. I'm looking at taking 706 puts, but there'll be a little bit of a roll off on IV after the 2 p.m. announcement, but the bigger roll off is usually right after that Jay Powell starts speaking. Thinking of taking a spread trade on the indices. The primary bet will be bullish. Sorry, the primary bet will be bearish, not bullish. Not bullish. Not with oil up 6.87, well over 100. That's for sure. So the primary bet is bearish for me. Looking at 706, I think that's a pretty conservative retrace. This head and shoulders on the 30, which is triggered, could actually send us all the way down to 701.50. I don't think they're going to flush us that hard that fast into the end of the day. We've seen it before. We've seen it here off of announcements. But I don't think they're going to flush us there that quickly. That's why 706 is a pretty conservative target from here, down about 0.5%, 0.6%. That would put the S&P down less than 1%. 1% down on the S&P would be what? So we're down 0.2, basically 0.25%. So 1% down would take the S&P to about 704.50. So I think 706 gives us a small buffer in case they don't want to sell it too hard today and maybe they continue it tomorrow. So I'm looking at 706 puts, and honestly, I'm considering getting in with this little bit of an uptick. We are off of the lows here. We've already had a couple or just over $1 bounce. I'm contemplating. Pop looks like they're trying to fade it. Hmm. Well, that would have been a good entry right there off that zone. So, All right, so I nibbled on some puts there on SPY. That's a good pop. Some zero DTEs. This is kind of an FOMC play. I took about a half position there off of that pop on the put side. I'll still trade, and it's sizing appropriate, sizing for loss if you're going to play, but that's a nice little bounce that we've had intraday. Sorry for saying I think we can go up. Yeah, there's always that potential. There is always that potential. Anything is possible. You're not playing SPY to, yeah, they usually make the indices a losing game. It's tough for sure. Does seem like there's going to be maybe some follow through. Small size I'm playing with, very small. I'm okay with letting these go to zero, but we'll see what happens. Come FOMC, QQQ getting a nice pop. Semis are once again holding steady, Nvidia gaining some liquidity. I'm not too sure what is causing the pop in the market. I am not too sure. I know oil is falling a little bit. Yeah, that's the primary reason. Into 706 SPY puts, 7060 DTEs. So it's till the interest rate decision, and the decision will be a hold unless Powell comes out and says, fuck it, it's my last FOMC, I'm raising rates, and then it'll be a bloodbath. Imagine Powell was legendary and did that. He says, my last FOMC, I'm just gonna shock the market. I've never seen the Fed watch tool. I think in my whole career, guys, I've never seen the Fed watch tool at 100%. It's usually like 99.9 or 99.8. I've never seen it at 100%. Ever. That would be wild. Imagine he said, fuck it. They're gonna write my name in history. Surprise raising rates. That would be that would be wild. He has the power to do that. He has the power. It's a nasty drop on Robinhood. Robinhood stock is cooked, guys. I think Robinhood, it's a bold call, but I think Robinhood's going sub 60. Excuse me, guys. God, to think, guys, we have. It's gonna be crazy because we get through Fed and then bang, right at 4, we start getting into earnings. My goodness, it's gonna be wild out here. Tomorrow's gonna be a crazy day. Might even be worth taking upside calls one days and downside puts one days because we're gonna get some movements on earnings. So that's another way you can play. Instead of zeros, which may get burned out for IV crush time, one days might be the better play for tomorrow. All right, this is where we get a little bit of increased volume and wicks. This is pretty much algorithmic trading that's going to take place in the next minute. It's the smaller of the two moves, generally speaking. You usually get a little bit of volatility here. Hopefully, yeah. Yeah, usually you get a wick up or down and then they settle the markets kind of in the same spot. So SPY's trading around 710.50. Wouldn't be surprised to see price action kind of just settle around back at that same vicinity. Boom, guys, Powell raises rates by 1%. No, I'm just kidding. I'm kidding. Nice decline there, though. Don't know what it is. Federal Reserve keeps the rates unchanged. Unchanged. No rate cut. No rate raise. We hold and steady. Voted 11-1. Our SPY puts are now up nicely, but again, I'm looking for a big move. I don't know if we're going to get it here. I'm seeing Nvidia starting to lose a little bit of momentum. Intel still strong. Microsoft coming into touch with that S&P decline. Again, they usually like to pin markets back in that same little box. Did the US 2-year yield do anything? Wow, big, yeah. No, that's staying firm. So there was a little bit of a spike on your 2-year yield and your 10-year yield, a little bit of an uptick there. That's why the market's kind of reacting. If we pull that up, you can see our US 2-year yield, obviously still just ripping. Nice little 10-minute spike candle there off that rate decision. 2-year yield has broken out here with force. Obviously the day's not closed, but it's looking pretty likely it wants to go higher. Nice decline, guys. Nice decline. This is why I grabbed a little bit of puts off of that pop, because I wanted to get a little, make sure I get some exposure and action ahead, because everyone's waiting for 230 and there's no rhyme or reason the market should have popped that much there. If you're wanting to trim, I'm gonna hold my puts, but we're up quite nicely here. If we get a flush into this low pivot and we undercut it, I'll probably sell half of my cons, because they might try to buy it back up and pin us somewhere between opening range low and high into the Fed meeting. But decent little decline there. Semis are still holding resiliency. Yep, VIX is getting perky. Let's take a peek at the VIX. Yeah, a little bit of a buy program hitting the VIX. Nice decline, guys. Nice decline. All right, we're getting there. We're getting there. There may sell this market ahead. This is why I jumped into some puts half the time. Come on. Again, undercutting this high here, or undercutting this low, I'll probably trim one. Nvidia really breaking down here. Yep. Watch them dump the market today on FOMC. We've seen this playbook before. They dump the market and then they pump it up back on mega cap tech earnings. That'd be crazy. So you might get a two-sided trade here where they dump us on FOMC and then pump us in the after hours. We have seen that. So if we get a hard sell into the end of the day, it's worth taking a little bit of a lotto swing. So I'm hoping I can make money on the put side, roll those profits into a little bit of a lotto long for mag earnings. That's at least what I'm thinking. All right, in case we get a pump, I am going to take off of this dip now. I'm going to build into a spread. I'm going to take a 713 call, 0 DTE. So I'm already in the puts. Those are up nicely. I'm going to take a small hedge, 713, 0 DTE call. I want to see that undercut low though before I enter. It's getting very close. Fuck, I'm not really that bullish on the market though. Holy, look at that Dixie spike. Fuck that. Actually, I ain't taking shit. I ain't taking calls yet. This is too crazy. What is happening? Look at this US dollar. EXY. What a fat candle pump. Let's see what gold's doing. This is technically a decent pullback to try to take a lotto long. You're buying the dip, counter trend. That's what FOMC is all about. I'm debating scooping up a 7 or 713 call. Nah, let's just stick with my puts. Fuck it. That would be the zone to try to take a little bit of a lotto long. So this is setting up very differently than most. Usually the 2 p.m. candle to 229, they pin us in a tight range. We haven't seen that. We're just seeing straight sell side pressure. Straight sell side. All right, our puts are printing here, guys. We're sweeping that low, guys. That's a good undercut of that area. Getting close to a trim. Getting very close. Man, they might just melt us. All right, guys, I trimmed half. I trimmed half on an undercut of that low. Boom. Still got some runners. So I was just shy of 70% gain, guys, in 10 minutes. Just shy of 70% gain in 10 minutes. Stop loss is at break even for me. We let the runners run. Dollar's still ripping. Nvidia dumping. Semis are dumping. Dump this market, baby. I'd love to see it dump. Give us a hard dump. They should. Oh, look at the flush, guys. We're up over 100% right now on our puts. Letting them run. Go, 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 baby. Let's get paid. Come on, dump this market, man. You got much more downside to go. Come on. Give me that 30 EMA tap. Give it to me. Head, shoulders, knees and toes. Knees and toes. We should go lower. But that's a beautiful little sweep. Yeah, VIX spike. Yep, I see that. Nice VIX spike. So the best strategy, guys, on Fed Day is to counter trend. You short the pops like we did here, and you buy the dips. So again, into that 230 time frame, 229-ish. I'll play PAL in the background too, but into that 229 time frame, um, if we stay depressed, you still could get a big spike up on some dovish commentary. But I don't know how PAL can be dovish with oil this high. I feel like if oil was trading back in the 90s, maybe he could be a little bit more lenient, but just don't see it. Is anyone playing earnings? So during that sell-off, guys, we've seen the main stock I've seen sell off, break down is Nvidia. Nvidia has been really hit pretty hard there. Microsoft, little dip but holding steady. Intel stayed steady. IGV trying to bounce. AMD bouncing. Micron bouncing. Broadcom bouncing. Meta, big bounce. Amazon, big bounce. Yeah, mainly the sell-off I'm observing is NVIDIA. Hard candle down there. Interesting. What a 10-minute candle on the Dixie, guys. Look at that 10-minute candle. That's crazy, eh? What happened to gold? Smackdown, yep. Silver. How's silver today? Down 2.6. Maybe I'll take a uranium call. Uranium call. It is a position I want to get into. Hmm. Yeah, there you go. So if you bought the dip there, guys, good job because that's proving to be a nice bounce. Really strong bounce. That's it. Counter trend trading on FOMC day usually results in profits. That's also a shortable candle. So that was a nice little take profit zone. A sweep and swipe of the low. Boom. PayPal news. There's PayPal news, guys. Holy shit, let's go. Go fucking PayPal. What a stick. Look at that stick on PYPL, guys. Big stick news on PayPal. What's the news? Making Venmo a standalone business unit. Boom. Big push on PayPal. And this is another stock that, fuck, it's just taking my money. I needed to really perk up. My average is pretty shit on that stock, but it's not terrible. I got shares sitting at 58 bucks here. That one's gone a lot deeper than I anticipated. Opening range low back test, that is a shortable spot, guys. It's obviously risky. Into FOMC, we got Powell coming in, what, 11 minutes? Papa Powell. Let's pull up the stream. What do we got? I'll play Powell in the background. What is Federal Reserve? Had a brain fart there for a second. All right, I got the stream queued up so we can hear Powell in the background. All right, what's everyone's predictions for earnings? We got let's look through here. Who's first anyways? So Amazon's at 401. Google's at 403, Meta and Microsoft at 405. Qualcomm 4 o'clock. Chipotle 410. Carvana 405. Ford is 405. My predictions: Amazon up, Microsoft down, Meta down, Google up. Those are my predictions. 4 minutes, guys, till Papa Pow. What color tie is he wearing? Crude oil holding up 6.65%. Let's get it. If this market pumps off of Powell, I'll be shocked. I'll be shocked if it pumps, man. Everything is pointing towards downside. Yields, oil, oil. Fuck, look at Amazon though. Amazon's a beast, 263, beast mode. It's pricing in a stellar earnings. All right. I got it ready here in the background, guys. I don't know if everyone can hear the stream right now. The music. Got the volume turned down a little bit. All right, here he comes, guys. Here he comes. Let's turn him up for you guys. He's late. He's late. He's loading up on his puts. Here we go. Puts are already paying. Dollar oil moving. He is late. Showing the stage. Market's not liking the delay. All right, here he comes. Purple tie.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was there?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. As I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think, left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook.
In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation's 3.2.
Those incoming?
Moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and I that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow on, the new leadership also seem rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools?
So I'm not going to give him any advice through you today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things, and if that happens, it feels like it's going to happen. That's a completely appropriate thing.
Neil. Hi, Chair Powell, Neil Irwin with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. We were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Chris.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market, and should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many reports of, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out, and it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very similarly all over the world that had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and we for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm waiting, for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So nobody, the three dissenters and others who could have supported that, and others who were, who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, it's a form of forward guidance, and you don't want to make them in a way that will be sustained and continue to make sense, and not something you need to take back, fairly quickly. So I think we just a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument, too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got three dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Thank you, Chair Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can... Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know it, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus, and I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be, they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because that was it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, there were elevated concerns about the bleed into core, and here we are with 3 cents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know until we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with just with SEPs. Can you talk about why you see that as a net positive?
So we always said when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings. And doing that without a press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to. And I do think it's quite helpful to I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message, and it's going to be all over the place because we do, thankfully, have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented any action on those changes?
So I'm not going to go into the real small specifics, but what we found very quickly was that making really large changes, for example, to the dot plot or the SEP, we couldn't come up with anything that had really broad support on the committee. And so we just moved on. We didn't really do as much on that as we might have. And I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And we've looked at a bunch of things, and it's something. Like I said, I think every new chair is going to look at our suite of communications and think about what would be changes. We are the only major central bank that doesn't publish a forecast, and that's because we have a 19-person committee, and you try to do that at the board. That's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve, and that's really where it is. As I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You know, you just have to find that out empirically. You know, given our the fact that we're, you know, a big exporter of energy and that our economy is far less energy intensive, oil intensive than it was during the 70s, you know, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is you know, a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
You know, the neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it, you know, between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. You know, I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking, you know, meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992. Are you handing off a divided Fed?
You know, the thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, you know, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? You know, it's the central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. You know, people are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets, so they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down to offset the inflationary effects. So it's not the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message it sends to President Trump by staying on?
I'll stand on what I said earlier.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it, too, is do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about, and we've had to do that, and we've been successful so far. But that's not over. None of that is concluded yet, and it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it, and I'd like to think that we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves, but there are widespread concerns that these things may continue. That's all I'll say, and and that would be a problem. And so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. what, do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to, to consolidate Reserve Bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient, and Chris Waller is particularly passionate about that. Of course, so are the reserve, so are the presidents, and it's a question of how do you accomplish it. We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that, but everybody's on the same page. The other thing he touched on was the idea of removing Reserve Bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine. Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right. I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that, but we try to get there over time in a way that does the least damage possible, and our commitment to that is never-ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance. But it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. Inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, there's a lot of signaling going on when you change guidance like that. And so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it. And of course, we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. You've made many tough decisions in your time at the Fed, and as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, we, all of us together, have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years, and that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management. And there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging, and we've tried to do our very best through these really challenging times, and I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about it, an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations, completely ignore them. This isn't bipartisan, this is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, oh, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last one.
Thank you, Chair Powell. Richard Escobedo with CBS News. We've talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, certainly none from this, but you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
Right, guys, so that was Jerome Powell's last Federal Reserve press conference. Obviously, he will still have a little bit of influence, but we can be expecting a new Fed chair come the next FOMC meeting. Overall, surprising to see the markets pushing back to the highs, but Powell saying the market is betting on Fed credibility, which I honestly don't believe, but that's just the nature of the beast. Remember, we got 30 minutes left, 35 minutes left in the session, and we'll see if there's any sort of de-risking into the end of the day here. Lots of mags reporting, guys. Lots, 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 lots. I am taking a couple earnings plays. Just a couple. They are lottos. Sized appropriately if you're going to play. All right. Be prepared if you play earnings for your contracts to go to zero if you're playing options. All right. So the dollar did soften up a bit, but it's still very strong, holding above opening range levels. Crude oil still pushing for a new high of day. I still think there's a chance that we can get a big sell into the end of the session here. Part and parcel, we could see some mag positions reducing here. Very surprised to see the markets held quite firmly here. I wouldn't say Powell. I think Powell was definitely more dovish as well today, but really wasn't anything crazy dovish. Here you can see semis are trying to get a bit of a breakout. Intraday inverse head and shoulders takes SOXX to new highs. Can you believe that if that occurs? That'd be wild. Yeah, it was a pretty lackluster FOMC. I think that part and parcel to lackluster FOMC because we had some initial selling into the beginning of the day. Big sell here right ahead of that FOMC presentation. Big bounce, but it's been pretty lackluster. Definitely some tradable ranges, but I think the bigger movement is after hours, guys. After hours. I am taking some positions in Microsoft and Amazon as my lotto fun money plays. So what's interesting here, guys, is if we have the Russell 2000, it was leading the charge on most of this rally. Now it's starting to lead the charge to the downside. So you have to wonder, is the Russell giving us a little bit of a foreshadowing preface of what maybe the S&P is going to be doing here? Maybe. Maybe it just might. It's going to plummet here into the end of the day. I think we get some hard sell side pressure for their last 30 minutes. They're probably going to throw the baby out with the bathwater. Lots of people are going to de-risk into the MAG earnings, and crude oil is just pumping up 7.76 WTI, 104.80. What a beast. Holy moly. That thing is flying, guys. Don't be surprised if we see a bloodbath into the end of the day. I could see a hard flush right back down to the lows. We should be at the lows of the day. Nice hard sell, guys. Nice hard sell. Crude oil is pumping, ripping. Crude oil is absolutely flying. Chipotle also after hour. Lots of names after hours. Woof, look at the spike on oil, guys. Oh my goodness gracious me. Did the US just strike or what? Look at this move, guys. This is crazy. Look at oil short squeezing. Squeezing. Oh my goodness. That is filthy. That's gnarly, guys. That 2-year yield is squeezing to the top side as well. Just a heads up, guys, if anyone cares, Champions League soccer is on and Arsenal's winning. That's my team. We're going all the way. Let's go. Arsenal 1-0, Atletico 0. Let's get it. Nick is saying in the 80s you went to several games in Germany. Borussia was amazing. Yeah, the vibes in the soccer stadiums are crazy, crazy cool, especially in Europe. I was lucky to be in South Africa for the World Cup back in 2010, and then I've seen only one game in England, a Manchester United game, and it was a pretty small stadium. Not Manchester United, but Fulham. Only like 25,000 people, but it was still wild. But the World Cup vibes were crazy. I'm super excited for the World Cup this year. It's going to be a lot of fun. What's Tesla been doing lately? Tesla, is it ready to move? Man, look at that poet stock, guys. I remember hearing, man, poet got killed. I remember hearing people saying, "Oh, poet's going to 25, 26 next week," and now look at it. Just cut in half and then some. Wild stuff. Even drones got smoked today. Absolutely killed. Ondas looking nasty again. Joby, how's that one doing today? JOBY. Yeah, that one's defending the lows. That one was down substantially more, so at least you're seeing some buy side pressure. Archer. Yeah, Archer's trying. Open door is green. Open door is trying to break out here. OPEN. Interesting. That's kind of fallen out of the limelight, which usually means that it could make a run. Not a bad base that's been built here. Above all the key daily chart. If this gets above that 200-day moving average, open door is going to squeeze, guys. Just keep that one on your radar. Airlines have been hit pretty hard today. Jets ETF down sharply. Wow, look at that free fall. Jets clobbered. Ford. We've also got CMG earnings after hours. Obviously Meta. It's going to be an interesting one too. Let's go. Amazon. Let's get a blow off top. 280. 280. Let's go. All right, guys. Good luck for earnings if you're playing. We'll see what happens after hours. Take it easy, everybody.